let's bring in Martin Crabb. He's joining us from Shaw and Partner. He is the CIO there. Martin, what's gone so wrong today?
Yeah, it's interesting. If you just looked at the lead from overseas this morning, you would have said, look, we're going to be down 1% today. We were there on the open, down 1%, but then all that buying came in the morning, and it seemed to be around growth stocks. It was the usual Afterpay. I saw ResMed was in there, Cochlear was in there, Domino's was in there. It seemed to be maybe a portfolio or maybe just some repositioning into those stocks. But I think the other story of the day, which you were talking about earlier, was the currency. So it's obviously under pressure. The US is under pressure, but the Aussie's under even more pressure. So I think a combination of a weaker currency and a market that just ran into profit taking. We're up over 7% this month. So you kind of got to expect a few people got to take some profits here and there.
Yeah, because this is the third down day then in the past 2 weeks, so it has been a pretty good run, particularly when you compare with what's happening overseas at the moment.
Yeah, I mean, we're supposed to be entering a period of massive geopolitical risk, right? We've got this uncertain election, we've got Brexit, we don't know what's really happening with monetary policy, so we shouldn't
and
be...
the background of COVID.
Exactly,
rising at the same time.
So, and who's going to lock down? Wales locked down overnight. Is the whole UK going to lock down? What's happening with Victoria? What's happening with domestic economy? What's happening with payrolls? There's a whole bunch of uncertainty out there. Why is the market up 7% this month? Now, a lot of it's because of that uncertainty is just being dealt with, and with the election seems to be forming a view, or the market's forming a view about the election. But I think the 7% run that we've had in this market this month is too much too fast. And so having days like today is just kind of unhealthy, if you like.
Okay, so too much too fast, but still, we have, generally speaking, underperformed the gains that we've seen on other global markets since the bottoms of March 23rd. So I know you didn't bring your crystal ball with you, but where do you see this playing out, or how do you see this playing out in the next couple of weeks before the US election?
Yeah, I mean, the key variable there is a vaccine. So there are 11 of them in phase 3 at the moment. So we're hopeful, as are the people in healthcare that we talk to, are hopeful that we'll get some data before the end of the month. We won't actually get a vaccine, obviously, until next year. But I think markets will respond positively to that, because these second and third waves that we're seeing, they're starting to get really scary. Governments are seriously considering locking down again. That's going to knock the economy down and knock the market around. So we're sort of hoping for a vaccine. If we don't get a vaccine, all bets are off. But we're pretty confident that we'll get something, because there's just so much going on at the moment, that we'll get either Moderna, Pfizer, AstraZeneca, one of those companies will announce some data, and that'll obviously underpin a healthy rally in the market. What the Reserve Bank was very clear about today in their speech, and also in the past couple of days, they're just going to put the foot absolutely flat to the floor. Rates aren't going anywhere for maybe a decade, right? They're going to flatten that yield curve, and they're just going to push as much money into the market as they need to, and that's obviously keeping the equity market buoyant as well.
All right, well, and speaking of which, you're saying it's somewhat overcooked over the past 2 weeks. So are you seeing any buying opportunities, particularly as we head into the election?
Yeah, I mean, one of the things we're talking to clients about at the moment is just the banking sector. So look at what's been beaten up during coronavirus that hasn't really recovered. A lot of sectors that did get beaten up have recovered substantially. So travel's a really good example there. The banking sector, it's still on its knees from a valuation perspective. So we've seen some data in the past few days that supports the view that there is credit growth and emerging for new home buyers, for example. So Stockland's data again today on their record number of sales for the quarter. We saw some data from AFG, one of the big brokers, mortgage brokers, the other day, showing that a record number of settlements for them for the September quarter. So this is with the second biggest state in Australia locked down, and they're still getting record volume. So there's a very good lending volume for the banks. Bad and doubtful debts will be lower than the market thinks, and net interest margins from the Bank of Queensland result a week ago actually grew. So we think the market's super pessimistic on the banks, and obviously everyone's concerned that APRA's put a lid on their dividends as well. So we think APRA will remove that lid and allow them to pay their dividends, and you should see the share prices respond accordingly.
Okay, so you're buying them all? You prefer one over the other?
Yeah.
How do you play it?
I mean, they're so generic. I mean, everyone tries to sort of put differences around them, but they are pretty much all the same thing. They all move together. The CommBank is the standout because it's the strongest business. It has the best franchise, and it's growing market share the fastest. So it's by far the number one pick in the sector, but a lot of people are already there. So the question becomes to them, am I going to add more to CBA, or am I going to look further down the quality? So NAB's the number 2 pick for us. So we've got about 12% of our portfolio in CBA. We've got just under 9% in NAB. So the question for us is, do we throw in Westpac or ANZ? And for us, Westpac is the standout of the two. So we think Westpac's probably getting reasonable good gains in the mortgage business, and the valuation looks pretty attractive to us too.
Let me throw another one at you, a sector that's been absolutely pummeled the past 6 months because of the pandemic, is the energy sector. As Australia begins to reopen, do you see any opportunities there?
Yeah, again, that's probably one that we've been long and wrong, Andrew, if I can use that phrase. So we're believers that global oil demand will recover, maybe not back to pre-COVID level, which is about 100 million barrels a day, but it will recover towards that number. And the second part of that is that we will need $70 oil price for people to want to invest in finding more oil, because it's a depleting asset, right? So you've got to keep looking for it. So we think the industry needs $70 oil, and we think demand goes back towards maybe high 90s in terms of demand production. So both of those things, you run them through your model to get much higher share prices for the energy sector. So we're long Beach Energy and we're long Woodside, and we also like Santos, and we're there waiting for this day to come. Some days it looks great, you get a 4 or 5% move high, and the next day the Saudis pump more or something like that. So it's obviously very geopolitical as well, with Russia in there as well. So it is a bit tricky, but we think that's, again, a sector that should do well if and when we get a vaccine announced as well.
And a lot of weight of expectations, I think, especially when we get through this US election, will be on that vaccine scenario and how it plays out.
Yep.
You mentioned commodities. I'll mention nickel.
Yeah.
Nickel hit an 11-month high.
Yeah.
But price and a sound investment is often a very different thing.
Yeah. It's interesting. You had the CEO of Nickel Mines on just before, right? Fantastic story, and they've done really well. I mean, that asset that they've acquired looks like a really good deal. And that stock has tracked the nickel price almost perfectly. It's almost like a nickel warrant. So the biggest players in the Aussie nickel market, I mean, they're the biggest pure play. But you've got independents and Western Areas who are also big players, but they have other commodities in there. So Western Areas and Independence Gold, we've got a very messy bunch of charts there.
Yeah.
They've all got the nickel price on them in the black line, so that's common to all of them. That might even be the Aussie dollar nickel price, which is about $10. $10 a pound,
I don't have
think.
my magnifying glasses on, but I'm going to take a guess and say it is.
It's got on the right hand axis, I think it goes up to 10, which is the Aussie dollar nickel price per pound. So it's been absolutely ripping, right? And as you said, that's a really high price. On the left hand axis is the share prices of each one of these. So you can see independents and Western Areas have just been going nowhere, and yet the ones down the bottom, Mincor and Nickel Mines, who you had on the show earlier, have been tracking that price. The other one's Panoramic in the middle, which is kind of not tracked it as well. So we think that 2 of the stocks are following the price and 2.5 stocks aren't. So I think if you want to play the nickel, it's really an electrical vehicle battery materials story. So we kind of like nickel, but we think maybe have a look at Western Areas and Independence as a way to play it right now, because they haven't caught up with the price, whereas Mincor and Nickel Mines have tracked quite nicely.
All right, another interesting sector, property. Gee whiz, it hasn't really panned out as people expected at the beginning of the pandemic. Okay, let's look at the specifics. Stockland. What's your thinking at the moment?
Yeah, so obviously Stockland's a good one to look at, Andrew, because it's got a bit of everything. It's got industrial, it's got commercial, residential, retail. It's got a bit of everything. So just sort of pulling through some of their charts that they had in their Q1 today. So this is the monthly inquiries around residential. So you can see they absolutely plummeted in March, April. So this is people looking to acquire about houses. And then they went nuts in May and June, because that's when the government announced all that stimulus measures. They have tapered off a little bit since then, but they're still running at levels above 12 months ago. So there is still quite a lot of interest, even though, and they've split out Victoria there just to show how significant that is, and the shutdown is there. But the rest of the country is performing quite well. So they did mention that their property settlements of just, I think, 1,799 property settlements for the quarter is the highest that they've ever achieved in the last 3 years. So things going very well in resi, which backs up that banking credit growth story. If you look at some of the other parts of their business, though, retail's a worry. I think they're only collecting about 75% of the rents even now, when a lot of the countries sort of started to come out of lockdown. So that's still 25% of tenants not able to pay their rents to Stockland, which is a bit of a concern. And also the other issue is just is office. Is office ever going to return to where it was? So we're very wary about retail shopping malls, and we're very worried about longer term about office. Office looks okay at the moment, but it's more about as businesses come back to full operation, are they going to use the office space? I understand Barangaroo's only got 5 or 6 floors. So when I hop in the lift to come up here, there's only 5 floors that show up. So that suggests a lot of this building is vacant, whether or not those tenants actually return to being full tenants in the future.
I'm shocked when I get in the lift and there's another person in there still. Like, oh my gosh, make
right.
conversation now. So Stockland is too early for a buy because they're not providing guidance. Is that correct? And because of the retail exposure?
Look, I think you want to avoid a lot of what Stockland does. It's not a bad company or anything. I just think you want to avoid retail malls and you want to avoid commercial office buildings. So if you want to be in real estate, we still like industrial. Everyone loves industrial, right? Because it's a way to play your e-commerce as well. But I think you want to play it maybe through lending and play it through resi. I mean, that's obviously the way to play it.
All right, well, the curtain is coming down on a pretty negative session, but it's always a pleasure to have you on,
Always
no
good
matter
to
what
be here.
color's behind us, Martin.
right.
Thanks for
Martin.
coming.
Thank you.